Let's get started. Thank you for joining us today for our lunch presentation on state and local tax Nexus issues. If you want to learn more about some best practices on managing sales tax compliance, selling into multiple states, and having sales reps in various states, you're in the right spot. I'm Carolyn Powell. I am the Business Development Director here at Tronconi Seguera & Associates. I'll be your host today. There's a couple different ways you can engage with us before we get started. Again, I mentioned in the handout section is a copy of today's presentation and a bio on Tom. And also too, if you have any questions throughout the presentation, throw them in the questions section. We'll be keeping an eye on those and also answering them at the end. So feel free to put anything in there. At the end of today's presentation, you will receive a survey. If you could please complete that, that'll be helpful to us today. Give us some feedback. If you want to talk with Tom, talk with one of our other experts in-house, just let us know. If you have any specific questions, you can put that also in the survey. And also if you're looking for any specific topics for us to cover in 2023, I'm working on that schedule now, so shoot some ideas over to me. So without further ado, we'll get started. Tronconi Seguera & Associates is a certified public accounting and business consulting firm. Tom is our expert today. He is a CPA with over 20 years experience of public accounting with a background in a broad range of industries, everything from manufacturing, food, financial services, software, environmental remediation, and electronic commerce are just some of them. So I am going to turn it over to Tom and get us started today. Thank you, everybody.
Good afternoon, everybody, and welcome to, I guess we can call it Nexus at noon.
I like it.
I didn't come up with it, someone else did, but I stole it from them, so just want to give David Lover some credit on that. Thanks for attending today. We're going to talk about Nexus filing requirements and some compliance issues for sales tax and then some income franchise type taxes as well. I'm going to go through all this for sales tax first and then jump over to income tax. And at the end, we'll talk a little bit about voluntary disclosure programs as well for everybody. So first off, I guess on our next slide, Carolyn, I think everyone always wants to know, what is this mysterious concept of Nexus? And, you know, I found a very easy and simple definition. I think this was from the South Carolina Department of Revenue website, that Nexus is really a sufficient connection between a state and a taxpayer, which allows the state to impose its taxing jurisdiction on that taxpayer. States can't just tax anybody they feel like taxing. There has to be that connection. There has to be a transaction, an activity, some sort of property in the state before that state can impose its taxes on an out-of-state business. So once you do have Nexus, though, and Nexus can be different depending on the type of tax, which we'll see here, whether it's sales tax or income tax, it can be different. It's governed in some sense by federal law, but each state really has its own rules and whatnot related to this. I think the key thing is to know is that once you do have this Nexus connection, you know, you are on the hook. You are required to file returns and, you know, pay any tax that's due. So on the next slide, we're going to get into talking about sales and use tax. And, you know, prior to the United States Supreme Court decision in 2018 in South Dakota versus Wayfair, it was pretty simple. If you didn't have physical presence in a state, you wouldn't have Nexus for sales and use tax. You can see on the little map here from Avalara, all the green states that have physical presence Nexus laws. It was every single one of them except the 5 states that don't impose sales tax at all. So pretty simple concept, dating back to the Quill decision in 1992, that if you didn't have any type of physical presence, and by physical presence I mean you don't have an employee that is soliciting sales in a state, you don't own or lease real or tangible personal property, you don't have inventory in a warehouse or fulfillment center. Although actually with the fulfillment center, that might be changing a little based on a recent ruling from Pennsylvania. You know, have an employee working in the state, you're providing services such as installation, repair, training, or you have an agent or some kind of third-party rep maintaining a market in the state for you. Those were all examples of physical presence for sales and use tax. So if you weren't doing that in the state, if you just had your business here in New York, you were selling online, you were selling through the catalog, over the phone, word of mouth, whatsoever, you didn't have any type of physical presence, you didn't have to collect sales and use tax. So as you can imagine, the states weren't very happy about that. And, you know, with the changing economy, as we moved more into a digital economy in the early 2000s with the internet and e-commerce, the states finally got their chance in 2018, well, actually before 2018, around 2015 to change things. They put forth a number of different new legislation in states like Alabama, Tennessee, South Dakota. And finally, this worked its way up to the US Supreme Court. And in this Wayfair decision, Wayfair being the online retailer of furniture and home goods and whatnot, South Dakota took them to court, and you know, basically the Supreme Court said, yeah, you know what, this physical presence standard is outdated given the economy, really probably never should have had it in the first place, so we're going to overturn that. And with the South Dakota Wayfair decision, we created what is now an economic nexus concept for sales and use tax. And what do I mean by economic nexus? Basically, the state can require an out-of-state seller without physical presence in their state. With definition of a remote seller, basically someone selling into a state where they don't have physical presence. They can require these guys to collect and remit sales tax when their sales exceed a certain monetary or transactional threshold. So we've gone from physical presence then to this concept of economic nexus, whereby dollars of sales or a number of sales in a state create nexus. So that map that was just all green before now is very multicolored map with, you know, at least 8 different standards here of nexus across the United States. And you can see the most broad one is the $100,000 and 200 transactions. That was the South Dakota economic nexus standard in the Wayfair case. So basically, South Dakota said Wayfair has over $100,000 of sales in our state, easily more than 200 transactions with all the different customers they're selling to. That creates nexus. So the states wasted no time jumping on board with this. You know, as we'll see in the upcoming slides, we'll talk about some of the filing requirements. The states definitely acted quickly on this. And you can see there are differences too, because why would the states do something, you know, that, you know, combined and provide one standard for businesses? But this time it actually does make sense, because in all honesty, $100,000 of sales into a state like South Dakota is really not the same as $100,000 of sales into a New York, into a California, into Texas. And you can see those states have a lot larger thresholds on this map at $500,000. I mean, given the population, the size of the market there, obviously you would have so many more sellers registering in California, New York, and Texas, and that would overwhelm the system. It would be a burden to the system there. So basically what we're saying is now if you're a remote seller, you're required to register and collect sales or use tax once you exceed this economic nexus threshold. And you know, we have a more detailed chart that if you're interested in getting, Carolyn can email Carolyn and we can send you some more details that provides a little bit more information on each state's threshold and some of the topics we're going to talk about on the next slide. You know, the states did say, you know, anyone who is below their threshold, there is a small seller exception. You know, they don't, like I said, they don't want little guys. They don't want the little guys registering. You know, it's the dollars of sales tax coming in aren't worth the administrative burden. I mean, hundreds and thousands of more returns coming in, it would overwhelm the state's systems. But the states wanted that money anyway. So they found another way to get it through what they call marketplace facilitator laws. So if you're a small vendor, let's just say you've got a nice little brick and mortar shop, but you want to sell online, you think you've got a cool product that people are going to want to buy. So you get on Amazon, or you get on eBay or Etsy or Walmart or one of these marketplace sites where many people can, you know, sign on to be sellers and you sell on their platform. In a lot of these cases, these are smaller sellers. So what the state said, well, we don't want those small sellers all registering, but they're selling on Amazon. Amazon's a huge multinational company. It's already collecting sales tax in different states. We're going to make the marketplace facilitator, the Amazons of the world, we're going to make them responsible for collecting tax on behalf of these sellers. So the state's got the best of both worlds. If your sales were above their economic nexus thresholds, you're required to register and collect tax. Maybe you're a smaller seller. Maybe you don't have a website where you're selling on. You're just selling on Amazon. Well, we're going to get you there too as well, because Amazon's going to collect the tax on your behalf. So the state's really worked out perfect situation here for them. And you know, for marketplace sellers, those who sell on Amazon, if all you do is sell on Amazon or Walmart or eBay, you don't have to worry about sales tax compliance for the most part, as long as you don't have your own website. As long as you're not doing direct-to-consumer sales on your own platform, you're good. Multi-channel sellers like that, you know, they have to be worried about that. So there's a number of issues we need to consider before, you know, you're registering to collect tax. And you might be saying, oh my God, I got to get out there. You know, my sales are over 100,000 in a bunch of states. You know, I have over 200 transactions in these states. What should I do? Well, first and foremost, you need to look at the effective date of these economic nexus thresholds. For the most part, 2018 and 2019 were when most of the states enacted these thresholds. So we're 4 years past that now. You know, you can see here in 2020, Alaska, even though it doesn't have a statewide sales tax, it allows its municipalities to collect tax. Louisiana and Florida and Kansas in 21, and now coming up, the last state is finally going online with economic nexus, January 1st, 2023, Missouri. And I know from my clients who we do a lot of sales tax compliance for, Missouri's a big state, you know, for that. I mean, we're going to be registering soon for a number of different clients in Missouri, so that's one really you should watch out for. And you know, you have to, once you hit these thresholds as well, you know, the states have different time frames, whether it's within the next 30 days or within the next quarter. I think Kansas says on your next sale that they want you to start registering and collecting tax for. So you really need to keep on top of your sales and look at them on a monthly, look at them on a quarterly basis to see if you're tripping these thresholds. I know I do that for a number of my clients. I look at them quarterly. You know, I know there's a couple states I'm always focusing on, and it's, you know, oh, are we getting close? Are we getting close? So I can let my client know, hey, you know, in a month from now, we may need to register in X state, you know, to get them ready for that. Because we do have other things to do with switching the state on and the sales tax systems and whatnot. So it's not as simple as just collecting the tax. The other issue too with this is, again, we're talking, some of these states are 4 years. What do you do if you're just thinking about this now, or this is just coming into focus for you, and you may have had sales over the last few years that have tripped these thresholds? we'll talk about voluntary disclosure and some other compliance options at the end here in the presentation. The other next issue you really got to focus on is, what is the measurement date, right? How do you know if you had $100,000 in sales or 200 transactions, or you 500,000 in sales, depending on the state? And of course, all the states have different rules. For the most part, it's the prior or the current calendar year. So, 2022, January of 2022, you look back to your 2021 sales. Did I trip Nexus? Then you register. Or, and here it is, it's October already. Maybe you've already hit $100,000 in sales, and now you have to start thinking about, when do I need to register? Some states also do a rolling 12-month period. So it's not really easy in a lot of cases just to look back. You've got to kind of keep detailed, maybe monthly, quarterly records, to determine when you may have tripped these thresholds. Now, what I think is probably the biggest issue, and probably the least maybe talked about issue with these, is what sales are includable in this threshold. How do you get to this 100,000 or 200 sales? Well, the states have different types of sales that they include. Most states use what we would call a gross sales threshold. So every single sale you make into that state, whether it's taxable, for resale, exempt, every single sale counts towards the threshold. That's the most commonplace. Then you have states that have what we call a retail sales threshold. So basically they're saying all your sales except sales for resale. So sales that maybe you're selling to a distributor, or you're selling to a retailer who's going to resell them. They wouldn't include that in a retail sale threshold, because a sale for resale is not considered a retail sale. So that's good. That helps a lot of people. And, a lot of times I've got clients who all they do is sell to distributors. And they might be, in a gross sales state and over $100,000, but there's no tax due. So that's when it comes to like, what do we do here? Do we register and file 0 returns? Or, do we live with some risk, but, do we make sure that we have the documentation for this? Do we have all our resale certificates in place?
Tom, can you touch on those resale certificates just real quick? Because Michael had a question, and I think this might answer it for him.
Sure.
Being some of our guests are not in the US, they might not know what that is.
So basically, yeah, it's a very US concept compared to the rest of the world that uses more of a value-added tax, where there's tax at every single layer of the transaction, from wholesale, to the manufacturer to, retailer. You're being taxed pyramids up, and you take credits. Here in the US, all we do is tax the end consumer. So if I'm a manufacturer and I'm buying materials, I could buy those materials for resale because I'm combining them and making a new product out of them. And then if I'm selling to a wholesaler, I get his resale certificate, and he's going to sell to different retailers or whomever who might collect the tax. So you want to get a resale certificate if you're selling to a distributor or any type of wholesaler out there. Very important to get.
Great, yeah, and they should just keep those in a file if they're ever questioned. And
file, electronic. I mean, there's software systems out there that can kind of keep them as a database. But yeah, you definitely want to get it. You want to refresh them every few years to make sure the information hasn't changed, because the worst thing that can happen is you get audited. You don't have these resale sales, these resale certificates or exemption certificates, and your customer has been acquired. They've gone out of business. Maybe there was a dispute or there's new management, and you can't get them. I mean, you're going to essentially be paying tax on a sale you never should have had to pay tax on. And it's going to come out of your pocket, this time around. So very critical for everybody. And even if like you tell me, hey, Tom, you know what? All I do is make sales for resale everywhere. I'm not going to do this. Well, again, It's a sale for resale, but if you don't have the proof, you don't have a piece of paper that says it's taxable. So very important that you get your certificates in order.
Perfect, great, thank you. And again, if you are selling to those resellers, when you ask them for that certificate, they'll know exactly what you
Yeah.
mean, and they'll send it immediately to you.
Yeah.
Okay, sorry to interrupt, Tom.
No. So then, essentially the other standard, the other type of includable sales is like a taxable sales. And that's really only, I want to say, in like New Mexico, Oklahoma, North Dakota uses a taxable sales, where all it is, you're including sales that should be taxed. Any resale sales, any exempt sales, where if you're selling to somebody who has an exemption certificate, you wouldn't include them. The other thing you need to watch for, the states have different rules. If you're one of those multi-channel sellers who maybe sells on Amazon, that sells on their own website, whether or not you've got to include those marketplace sales in those threshold counts. And some also exclude sales of services too. So it's just all over the place. I guess probably the biggest point too, because I talked about physical presence, right? And I said that changed after Wayfair. It did, but it didn't. If you have physical presence in a state, you're not a remote seller, right? So all the Wayfair stuff, all the economic nexus rules don't apply to you. If you're physically in that state, then you're required to register regardless of your sales dollars, regardless of your number of transactions. I mean, physical presence didn't go away as a nexus, creating activity. It's just now another arrow in the state's quiver to get you. So we added the economic nexus to make it easier for remote sellers, but if you're physically in a state, you're not a remote seller, just by definition. So you would have to register anyway.
And a remote seller can be somebody out of the country, correct?
Oh yeah. You can be a foreign, Canada, Mexico, Europe. Yeah, we do work for, clients who are all over the world selling into the US at this point.
So we're roping them into our rules.
Yeah, and again, just quickly with that is, everyone says, well, there's treaties and there's permanent establishment rules. That's great if you're dealing with the federal government, the US and the IRS. But when you're dealing with the states, the treaties don't apply. The states have their own rules, and they can go after foreign companies and require them to collect tax as anyone else, as any other company in the US. So
great. All right.
So you might be saying, Tom, hey, this is all good and everything, but the states are never going to catch me. I'm not a big fish. Maybe I got big sales in a few states like Illinois, New York, Texas, California, all the big states. I'll tell you what, because of COVID and because of a lot of things, the states have gotten really good at working remotely and auditing companies remotely. And they have a lot of different ways to find you, whether it's they send you a Nexus questionnaire and ask you a bunch of questions about your business activities in the state. That's been wrapped up by a lot of states. They're using data analytics. They're looking at income tax returns. They're looking at if you have employees that you're paying withholding tax for. They're looking at different sellers and websites and whatnot. They're sharing data across the border with other states. One of the big things is they're audits. Maybe your supplier is being audited. Maybe one of your customers was audited and the auditor said, oh, there's no sales tax on this. We're going to look this vendor up. And they see, oh, you're a huge company. Maybe your competitors, right? I mean, I hear this all the time. Well, my competitors aren't charging tax. My competitors aren't doing that. I mean, you could have somebody dropping a dime on you to a state saying, hey, I know this company that should be registered and collecting tax, and they're not. Too, with that, websites. States look at websites, and they have these you might have a great website that says you do all these wonderful things, and a state could be like, well, it looks like they're in our jurisdiction. One of the greatest stories I have is with deliveries. One of my partner's clients had a truck coming down from Canada, right? and they were stopped in New Jersey. And the New Jersey enforcement agent looked at it, looked them up on the tax rolls, saw they weren't registered, and they had to pay like $5,000 to get the truck released because they weren't registered to collect tax, and delivering in your own vehicle into a state creates Nexus. So states will find you. I mean, believe me, even Amazon has been subject to legal demands and subpoenas from states because they want to know who's got inventory in their warehouses. And they might have said over the years, oh, we're not going to flip, we're never going to disclose that information. Well, believe me, they have. In California and Pennsylvania and New York, New Jersey, Massachusetts, South Carolina, they have. So they're going to catch you at some point. So what do we do to get ahead of that? Because the last thing we don't want is the state to catch us, right? For sales and use tax, you've got to start planning, or you plan ahead for this. You need to, review those sales in your business activities to determine, whether you have Nexus and are required to file. Almost concurrently with that, you've got to look at your taxability of your products and services, right? You need to know if what you're selling is taxable or not, because that may impact whether or not you need to register as a remote seller. I underline the organized resale and exemption certificates. I can't tell you enough how important that is to have those certificates. Again, you might be a reseller. All your sales might be for resale. If you don't have that paperwork, it doesn't matter. And then I think, the big part here too is developing a plan for how are you going to handle this increased sales tax compliance. Do you have somebody on staff who can file these returns? I mean, do you have the technology to do it, right? I mean, do you have, a shopping cart like Shopify, or are you using something like Woo for your website? What do you need to do to collect tax within that platform and collect the correct amount of tax? Not that easy. Is it something you just want to outsource? There's lots of third parties, whether it's CPA firms like ours or technology companies who file returns for you. And, what is that going to cost you? I mean, there's a cost to all of this as well, to complying. And then finally, it's, what are we doing? We registering prospectively, right? Are we going to register as of 11/1/2022, or do we do like a voluntary disclosure and go back, which we'll talk about, or do you do nothing? I mean, that's always an option too. Maybe not the best, but in certain states it might be. So a lot to think about with sales tax as we move into this income tax here. I'm going to kind of go through the income tax a little quicker because, I think for a lot of people, sales tax, having Nexus for sales tax is a lot easier than income tax really these days. And, I think it's more critical for a lot of companies because, you're talking tax due potentially on every sale you make into a state, as opposed to an income tax where, you're apportioning your net income in a lot of states. It could be a lot lower dollar. That's what everyone always says. Income tax is, for state and local taxes always gets the big, talking point. But now really since 2018 it's shifted to where sales tax has kind of become the critical business tax issue for a lot of companies across the US. So income tax, how do we create Nexus? Well, physical presence obviously would create Nexus in a state. If you have employees in the state, which we're going to talk about because you'll see in a few minutes, employee activities in the state differ for income tax Nexus than sales tax. Are you owning, leasing property, real property in the state or anything like that? Most states physical presence isn't required to create Nexus for income tax, but having it is really a solid indication that you have Nexus, if you have people working in the state and whatnot. So then we also have a concept of economic nexus, right? Here we are, economic nexus for income tax. That's been around a lot longer than it has been for sales tax. Economic nexus, income tax wise, goes back to 1993 with this Jeffrey versus South Carolina case. Jeffrey being the Toys R Us giraffe, right? They held his trademark, the logo and everything in a intangible holding company, and that intangible holding company was making money in different states, from the Toys R Us stores who were using the logo and whatnot. So South Carolina kind of went after that and said, well, that's Nexus. You have Nexus. You're making money based on, your economic activity in our state. And, that won out in South Carolina. The U.S. Supreme Court declined to hear that case. So this economic nexus concept has been around for a while. Some, like I said, state courts and taxing authorities have applied it. Like West Virginia has a big MBNA decision. I think KFC has a couple issues out there with that. Other states have expressly put that in statute in their law. But really with the economic nexus, if you're not dealing with like a related party intangible holding company or like a financial institution with a credit card, bank, it really hasn't applied generally across the board to most companies. They've only really used this to states in very limited circumstances, right? So, states need something that's a little bit more black and white for income tax nexus. So back in 2002, the Multi-State Tax Commission came up with this concept of factor presence nexus, right? Where a company is considered to be doing business if its property, payroll, or sales exceeds certain thresholds. Oh my God, certain thresholds sound familiar, right? Very similar to sales and use tax. So, and the Wayfair threshold test. So basically the MTC, this Multi-State Tax Commission, all the states get together for the most part and, try to figure out ways how they're gonna work over taxpayers all across the board. They came up with this Nexus standard and, it's essentially 50,000 of property or 50,000 of payroll or sales of 500,000. That was like the basic thing, right? I mean, that's adjusted for inflation every year, right? And the states have different kind of guidelines on it. So you can see on the next slide, there's a number of states have these laws already. There's about 12, 13 of them here that have these factor presence laws. Some of them, like Ohio, Texas, and Washington, don't apply to an income tax, which we'll talk about in a minute. But the rest of these have, rules. Like Michigan, for example, is $350,000 of receipts. If you have $350,000 of sales into Michigan, you could have Nexus, but there are some limitations to that, which we'll talk about on the next slide. So you got to know, this is the most newest and most evolving concept. And given its similarity to Wayfair, I believe we're going to see more states moving to this factor presence type nexus, especially as they're trying to limit the federal government's limitations or restrictions on whether they can tax, on net income. So what is that on the next? Oh, Karen's already there. Beat me to it.
Sorry.
All right. So like I said, states can't just go willy-nilly taxing everybody. So what happened back in the late 1950s, if you believe we're talking that long ago, Congress passed what they call the Federal Interstate Income Tax Law, this PL 86272, Public Law 86272. So states are prohibited from imposing their net income tax on income derived within that state if their in-state activity is limited to just the mere solicitation of orders for tangible personal property, provided that the orders are sent out of state for approval and they're fulfilled by shipment or delivery from a point outside the state. So back in the late 50s, states were trying to run amok and tax out-of-state companies who were selling into their state, saying, oh, well, you have people, they're soliciting sales and whatnot, and Congress stepped in and limited that. So basically said, look, if all you're doing is soliciting sales, it's got a salesman, comes in the state, trying to sell some tangible personal property, the order has to get approved from the headquarters in a different state, and the properties being shipped into your state from a warehouse somewhere else, can't impose income tax on it. And essentially, that's kind of been the law for the last 60 years at this point. Now, there are some limitations to this, right? You heard me say net income tax. Well, that's right. PL 86272 only applies to a net income tax. It doesn't provide anybody protection against sales tax, property tax, gross receipts tax, which we'll talk about, corporate franchise taxes that are imposed on like your net worth or capital, minimum taxes and whatnot. Sales of services and digital property are not included as well. So if you're a service provider, you're going into a state to install something, PL 86272 is not going to cover you for income tax purposes. If you sell digital goods, it's not going to cover you. And then I think the other real big issue is the order must be fulfilled by a shipment from outside the state. Well, now if you're selling on, one of these marketplaces, maybe you have inventory in different states, right? So that could be an issue for you too, because what do we see now with 1-day shipping, 2-day shipping? These big marketplaces like Amazon move your inventory that you might have in their warehouse all over the country, so they can do that shipping very quickly. So you might have an issue with that nowadays for income tax purposes as well. So PL 86272 has its limitations, and the states have been trying to basically put it in a smaller and smaller box every year since 1959. They've come out with a couple different interpretations over the years of what they consider nexus and not nexus based on the parameters of PL 86272. We're going to talk about that in a minute because they just updated that again last year. So what are some of the, I would say, traps related to this? If a state imposes a gross receipts tax, that's based on your top level, top dollar, top line sales, gross revenue, gross receipts. It's not based on net income. So you have a very broad range, broad tax, broad base with little to no deductions, taxed at a low rate. And you can see here, there's a number of states, Delaware, Michigan, Nevada, New Mexico, Ohio, Oregon, Tennessee, Texas, Washington, that have gross receipts taxes. And if you recall, some of those are factor presence type states too. Ohio, for example, does not have an income tax. It has a commercial activity tax. It's not the same thing. It's based on gross receipts, and it's a low tax rate, but it's not precluded from 86272 protection. The Texas franchise tax, $1 million in sales. You could pay the franchise tax, and the Washington business and occupation tax, the B&O tax. Again, that has the same net threshold as they do for sales tax in Washington, $100,000. So these aren't net income taxes, they're something different. So you have to be careful of these taxes when you're selling into these types of states. A lot of states also have what they would consider a business privilege tax. Some states like California have fixed dollar minimum, $800 fixed dollar minimum tax for foreign companies selling into California. There's franchise taxes based on net worth or capital. A lot of these taxes are minimal dollar amounts, but if you don't comply with them, you don't file a return and pay them, the statute of limitations never starts to run. So these states, if they do catch you, can go back a very long time. and their interest and their penalties add up on this tax, and end up being multiple times over what the tax is. So you need to be very careful of these trap taxes.
Before we move on, I just hope you can clarify real quickly, the PL 86272 also applies to non-resident corporations. So again, companies outside the country selling in.
Yes and no.
Okay.
Some states will say that PL 86272 does not apply to a foreign company.
Okay.
It'll just apply to other companies in the US. You have to be very careful with that application. It's not across the board.
All right, to make it even more confusing.
Yeah, why not?
All right, thanks.
So to make it even more confusing, on the next slide, I'm going to talk about this touch on this next two slides real quick. I talked about how the Multi-State Tax Commission had guidance on what they considered a protected and unprotected activity for PL 86272. Well, again, they're trying to, basically bury it and make it so that it doesn't really apply anymore. So their latest iteration of guidance came out last August, where they're adding all these different activities that relate to how you interact with a taxpayer may interact with a company or a customer online over their website. And you can see on the next slide, some of the activities they would consider unprotected activities that would create Nexus are, post-sale assistance to customers by electronic chat or email. How many times do you see that now?
Oh, yeah.
Placement of cookies on devices to gather customer search information. If you're remotely fixing or upgrading products previously purchased by transmitting code or other electronic instructions, that's software, very easily. If you stream videos or music, or offering or selling extended warranties via your website, even inviting and accepting applications for non-sales positions through your website. These are all activities that the Multi-State Tax Commission says could create Nexus for you in a state now. This is just, you don't have any presence in the state, right? But this is what they're saying will create Nexus. And, in all honesty, it sounds crazy, right? And, these guidelines it's not automatically adopted by states. States have to legislate this through, right? And California and New York already have. California did in February, and New York just did it in April as part of the budget. They added a bunch of different activities. They didn't take the whole thing, but they added a bunch of activities. So again, you have to really watch this now, because this will be challenged in court and whatnot. They're just testing the boundaries of PL 86272 protection even more now. So you have to watch it. I find it interesting, and it's an update that I'm seeing a lot of people talk about, so I wanted to include it. But it is something you can see. The states are never resting. They always want to find a way. And the other thing that's really, another thing the states are doing is telecommuting employees, right? Remote workers. This has always been an issue, but COVID exacerbated this issue, because, how many times, you heard, well, I work in New York, but, I spent COVID in Florida, or I spent COVID in Connecticut or somewhere else. And, a lot of the states said, okay, well, if you had a telecommuting employee in our state as a result of COVID, it's not going to create Nexus. During the pandemic, not going to get into whether the pandemic is over or not, but it's over for what the states would consider tax purposes. And with remote workers not returning to the office, this is creating a lot of new state and local tax challenges for employers. You may never have been in the state of Ohio. Let's say you're a New York business. Now you've got somebody in Ohio, you've got somebody in Pennsylvania, maybe somebody in California working remotely. Well, you were never registered there, but now you may have to withhold income tax for them in those states, right? You're on the state's radar then. You might have sales tax filing obligations because you have physical presence. You could have income tax filing obligations. now, because if they're not a salesperson, if they're just maybe a marketing or a accounting or whatever type management person, they're not doing mere solicitation, they're doing other activities. So that's going to create Nexus for you. And then you have local laws, like Ohio has local income taxes, Pennsylvania does. So this remote worker thing is really going to be an issue. And it's even more of an issue if you had Nexus in that state and weren't doing anything about it. Because what do you do then? You just register, or you look back, and there's a lot of issues with it. So again, for income tax, talking about compliance, you really need to look at your activities, what's creating Nexus in each of those states, and do another like Nexus review, right? A lot of times I think it's beneficial for income tax purposes looking at that Nexus questionnaire that the state has and seeing the types of questions they're asking to determine whether you have income. You want to review your apportionment factors, your property, your payroll, your sales in those states, to see what your actual activity, what your presence is. Because again, with income tax, your net income tax, it's your revenue minus your deductions gets your net income, and then net income's apportioned to the different states based on these factors. So you might have, some liability, but it might not be huge. It might not be like sales tax. And then you got to understand what type of income tax we're looking at. Is it an income tax? Is it a gross receipts tax? Are there capital or minimum taxes I got to worry about? So there's a lot there. And really, again, some of the Nexus issues you need to look at on this page are, you can see that there's a bunch of things, similar to some instances with the sales tax, but different as well. So I wanted to skip over that and go right to the last couple slides, but I think they're important. And we've alluded to this a couple times in here with the concept of voluntary disclosure. And, let's just go back to the sales tax incident where, it's been a couple years since the state's economic nexus threshold has taken effect. You're just looking at this now and you realize, geez, what am I going to do? I've been over this threshold for 3 years already. And, you have options. Like I said, you do nothing. Hopefully the state doesn't contact you. You can just register prospectively as of November 1st and start collecting tax. That's great. I'm glad you're collecting tax. But when you're doing that registration, they're going to ask a lot of questions on the registration form, like, what are your sales? When did you start doing business in our state? I don't know if you really want to perjure yourself on one of these registration forms, right? Because that can open up a whole other bag of issues for you. So voluntary disclosure is a way for a taxpayer who has Nexus in a state to voluntarily, anonymously come forward to the state and negotiate what we call a voluntary disclosure agreement, a VDA, to cover your prior tax obligations. So, there are some issues if you have had prior contacts with the state, if they sent you a Nexus questionnaire, if you got a bill from them, if you were collecting and not remitting sales tax, although that's not as big of a deal. Anyway, it's a big deal, don't get me wrong, but in the states, they just want their money. Those are issues that would affect the eligibility of one of these. So basically what it is you prepare, most cases have a CPA, prepare an anonymous voluntary disclosure application or proposal letter. Most states want to go back whatever their statute of limitations is, but it's going to be limited to 3 or 4 years. Sometimes you can negotiate fewer years or fewer periods. You agree to register to collect tax and then pay your current liability. Whatever tax you should have collected over the last few years, you agree to pay that and you agree to pay future taxes. You pay that with some interest, for the look back period, like I said, 3 or 4 years, and they'll forgive all the civil penalties, during that look back period, and then you're in full compliance, everyone's happy. It sounds great. Again, problem is if you sales tax, you're coming out of your pocket, like most likely, to pay that. But is it better to pay it now than in 10 years when you've not registered and they're coming after you for 10 years? So it is, you know, it is something you need to consider. Some states have what we call amnesty occasionally, where they let you go back for a certain number of years and do that as well. But for sales tax, you're still coming out of pocket. You know, every state has a voluntary disclosure program. You know, you can look at a state website, you'll find it. There are varying requirements. And I think it's important that, you know, you've got to consider everything. Yeah, I know a lot of people who are blindly just want to go, oh, we'll just take care of the sales tax for me. Well, I really can't take care of the sales tax if you have income tax exposure as well, or withholding tax. I mean, we want to take care of it all, but you only got one crack at it, you know, at that point. And then our friends at the Multi-State Tax Commission, they also have a national Nexus program, national voluntary disclosure program that I think 38 states and the District of Columbia all participate in. It sounds cool, you know, you can go one-stop shopping to take care of a bunch of states, but you kind of end up dealing with all the states directly anyway. So it's, you know, 6 of one, half dozen of the other when it comes to that.
All right.
So yeah, if anyone has questions, I haven't answered, please feel free. You know, I know it's 12:53. I mean, I'll stick around, you know, after one. If anyone has questions they want to ask, you know, happy to answer them the best that I can.
So I think the one we answered, but if you can just reiterate for, you know, the voluntary disclosure, if they did not collect the sales tax, they're taking that out of their own pocket.
Yeah, I mean, yes, for the most part. Now, there are some ways around. I mean, you can go back to your customer. I mean, but if you're selling, you know, products online into like to me or you, you're not going back to that person. But if you're selling to like big companies, you might go back. You can also look. There's options too where you can. We call them XYZ letters. You send, you know, a letter to your big customers and say, hey, look, were you audited, you know, for this tax period? Did you accrue use tax on any of the purchases from us? Because if you can get that proof that they were audited or they remitted the tax themselves, you can kind of get out of paying the tax on it. But it's a lot of work. It's a lot of work.
Right. It just seems like there's so much, you know, good record keeping, either through a software or spreadsheets or whatever, of where you're selling, what those volumes are, and talking to your accountant before you go into a new state that maybe you've never sold in before to see what that's going to open you up to.
Definitely.
Some of these other questions I think we've answered along the way. Michael, Kristen, and Brennan, if you still have a question, let me know.
A remote employee working in a state make you a remote seller. No, that gives you physical presence. So yeah, remote seller stuff is pretty much off at that point. Are there any stipulations on wholesale manufacturing companies that sell to a specific state for an exemption? Well, yeah, if you're a manufacturing company, you know, I didn't really get into it. I mean, there is the resale exemption where you're selling to someone who's going to then resell that product. Or if you're, you know, a company that sells like manufacturing equipment or equipment used in R&D, or you're selling to, you know, a utility or somebody who is using your stuff in an exempt manner, you can get an exemption certificate, you know, from that as well, and that gets you out of collecting tax.
All right, looks like we have another one in here from Andy.
Yes. Are sales taxes considered fiduciary taxes? Could owners and officers be personally liable for the tax? Yes. Yes, when you fill out a sales tax registration application, they ask for what they call a responsible person. The responsible person should be an officer, owner of the company. That's the person the state goes after personally if your company fails to pay its sales tax. Good question.
All right, Tom's contact information is up here. If anybody would like to reach out to him directly, feel free to do so. Thank you again for joining us today. If you could complete the survey that you will receive, give us some feedback. Again, another opportunity to ask questions or set an appointment to meet with Tom. Let us know if there's any topics for 2023 that you would like to know about. I will also send you an email later today with a recording of the webinar, copy of the handouts, the slides. So if you want to go back and listen again to it or share it with a colleague, you'll be getting an email from me this afternoon.
Yeah, and just one final note, I mean, a lot of this, I mean, I'm not trying to specifically scare anybody with any of this stuff. I mean, a lot of it does sound scary and overly complicated, and it is, but when you're dealing with people who understand and, you know, do this every day, you know, it's easy to get it right. And then once, you know, we get the basics right here and we get you in compliance, you know, doing everything on a regular basis just becomes, you know, another daily activity, and it's not that overwhelming or hard. And I think the initial cost and scare of it, getting past that, it's well worth it, considering what happens if you never do comply down the road. So.
Great, thank you. Our next webinar will be in November. I will get back to you on the date for that, but the topic will be succession planning. So stay tuned for that, and you will see invites in your email box. Thank you again for joining us today, and we'll talk with you again soon.
Thank you.
Thanks, everyone.